Good morning. How are you doing? 5 a.m. in New York. It is 10 a.m. in London. Good morning. I'm Guy Johnson. In, of course, for Vonnie Quinn with your Bloomberg brief. Let's set you up for the day ahead. U.S. stocks notched a fresh record high Thursday as the latest read on inflation dampened rate hike bets. Retail sales, UMich consumer sentiment data are up next. E-minis pretty flat right now. Crude, though, is bouncing back. This as Treasury Secretary Bessent readies what's been called an unprecedented economic isolation plan for Iran. And Washington targets Beijing with 100% tariffs on imported drones. OK, you're up to what you need to know. Let's talk about where we are with these markets. I'm going to take you around the world. Here's Winnie Su in Hong Kong for the latest on Asia.
Yeah, good morning, Guy. Happy Friday. Now, we had a pretty decent week in Asia with the Asian stocks, MSCI Asia, in fact, up about 2.6% this week, having its best week in about 2 months. Overall, the sentiment is supported by easing concerns around the Federal Reserve to raise rates, but also memory stocks being supported by those bullish outlook from SanDisk. And you can see Kospi here up about 2.4%, leading gains in Asia. We are also observing the foreign inflows this week reaching the highest level since April. So really, we are seeing foreign investors coming back into the Korean market. Now, we are also seeing Japanese yen here edging just slightly higher, moving away from that 160 level against the dollar as investors continue to bet that the Bank of Japan will have to raise rates earlier. Now, flip aboard, we take a look at where the weakness really is still in those tech stocks in Hong Kong, specifically HS Tech having its worst week in about 2 months, but also the declines really being led by JD.com that logged its very first quarterly sales loss due to the weak domestic demand. But we do have Meituan announcing its earnings as well later today. So we will take a very close look on that as well.
Great stuff. Thank you very much indeed. Justina's here with a look at what we are watching in Europe.
Good morning, Guy. Now, it's a quiet Friday for what's been a really quiet week in Europe. The Stoxx Europe 600 is down a little bit today, dragged down by some of those mining names, but we're seeing big gains in software stocks today after the U.S. HR software maker Workday reportedly got a bid in the U.S. Now, looking at currencies here, generally it's a day of broad dollar weakness, so we're seeing some strength, particularly in the pound here before U.S. retail sales data later today. And in terms of bonds, we're seeing generally big gains in some of those bond yields, kind of underperforming treasuries with kind of oil rising again. And now if we flip the board here, we got some pretty good economic numbers out of Switzerland today, with the GDP growth beating every single analyst estimate, rising at the fastest pace since 2021. But what's been interesting is that the Swiss franc has actually been depreciating lately, with this cross rate against the euro at the weakest since late 2025. And the Swiss National Bank has reportedly, been thinking of not raising rates until the end of 2027. So it'll be interesting to see whether that changes and whether this trend in the exchange rate starts to turn.
OK, Justina, great stuff. Thank you. Let's talk a little bit about where we are in the United States. Big day yesterday, fresh records. This morning, futures are fairly flat. You can see that with the minis, NASDAQ futures also fairly flat. The buck's under a little bit of pressure. Now, that's unsurprising given what we're seeing in terms of the data. It is maybe turning down the idea that the Fed will need to raise rates, and that is negative for the dollar. The action yesterday also in the bond market. Let's take a look at 10s and 30s. This is the picture there. In some ways, it's the front end that's responding to the Fed. It's the 30-year, though, that is fascinating right now. It is responding to this competition for capital, which is really beginning to ramp up right now. And we saw evidence of that yesterday. 2001 was the last time we saw the US having to pay this kind of money to get a 30-year away. That is where we are this morning. Brent crude's up another 1%. We're going to get some action apparently next week from Scott Bessent. We're going to shift from Hegseth to Bessent as we see economic war being the new front when it comes to Iran. OK, you're up to speed with the markets. Let's talk about what is going to be coming up over the next hour. Stephanie Guild of Robinhood is going to be joining us to look ahead. Got plenty of data out today. You got UMich out a little bit later on. I'm fascinated to see what retail sales is going to tell us as well. All of this, of course, in the context as we work our way towards Jackson Hole. Looking forward to that. Let's talk about tech, though, because, again, as ever, there's a lot of news there that we need to dig into. Sources telling Bloomberg that OpenAI is now on track to double its annualized revenues. That's year on year, topping 40 billion. That's the number we're now looking at. This comes ahead of the company's plans, of course, for a Wall Street debut. an IPO. Joining us now to discuss, Matt Bloxham of Bloomberg Intelligence. If I wanted to IPO, I would boost my revenue. Is that what we're seeing here? Is this kind of IPO, is this setting up an IPO, or is this is a company that is expanding very rapidly?
I think it's more the latter. I mean, clearly there is, but you want to present yourself in the best possible light for an IPO. I think there's a distinction there. Some companies definitely kind of really push things aggressively, perhaps creating an unsustainable picture of their business. I think for OpenAI, a bit like Anthropic, it's a bit different. They are building the business. I think, though, OpenAI has had to kind of turbocharge its development path this year because it's been overtaken by Anthropic. And the difference there has been this focus on enterprise, so corporate customers, which has always been Anthropic's focus, and that's really delivered great revenue momentum for them. Yesterday we were hearing that they're going to exit this 2026 with $100 billion to $120 billion of annualized revenue, so 3 times this $40 billion number. And so I think OpenAI has had to kind of really accelerate its pivot into enterprise because that's where the revenue growth opportunity is. Historically,
is it behind in that space? So you're saying basically it's behind. Does that mean it's behind when it comes to the IPO? Is that the sequencing we're now looking at?
Yeah, I'd say probably at the beginning of the year would have said it's going to be OpenAI first and then Anthropic, and that's flipped. I think that the smart money, I think, right now would be on Anthropic coming first and OpenAI following.
Competition is coming as well. In the form of the Chinese models.
Yeah.
You've got another one, Z.ai, out this morning saying it's going to rival what we're getting from OpenAI, what we're getting from Anthropic.
Yeah.
I'm assuming the cost is lower in terms of what I as a consumer, I as a corporate will end up paying.
Yeah, absolutely. Although, even in China, we're seeing upward movement on pricing with the DeepSeek, quite substantial kind of 4 times increases in pricing. But overall, a combination of lower pricing and also the fact that these Chinese models are typically open source. And that's some of the news we're hearing today with the Z.ai model is that within the next couple of weeks for their most advanced model, all of the weights that drive these models will become open. And that's the real big differentiation between the likes of Anthropic and OpenAI is this concept of closed versus open. And I think that for a lot of more sophisticated clients, being able to kind of tailor the model to your own specific applications is important.
You bring up the pricing shift that we're beginning to see in China.
Yeah.
Is it a bit more nuanced than that? Is it basically them trying to push users to underutilise points in the day? Is this basically sort of dynamic pricing being put in place to even out the load?
Yeah, I think there is an element of that, and we saw with the DeepSeek pricing that there's this distinction now between peak and off-peak and trying to kind of shift some of that less urgent workload into cheaper times of the day from an energy consumption perspective. I guess it's classic energy consumption behaviour. But I think that there's another kind of angle to this is all of these companies, although a lot of the focus is on their most advanced frontier models, they all have a big stack of models that target different types of customer, particularly around price sensitivity. And so whilst there's a lot of focus on the relative kind of cost of like DeepSeek versus kind of Fable, for example, actually, further down the track, there's a lot more cheaper models. So even with an OpenAI or an Anthropic, there are much more price competitive models if you're prepared to accept lower performance. And in some situations, lower performance is totally fine.
Just pick and choose.
Yeah.
Matt, great to see you. We'll be back a little bit later. Matt Bloxham on the latest tech stories. Over in Washington, the Trump administration apparently is imposing tariffs on up to 100% on imported drones and their components. The move further raising US-China tensions ahead of President Trump and President Xi's summit, which is coming up this fall. Shares of some of the drone makers are higher in pre-market trading in the United States on the back of this announcement, as you can see on the screen. Ros Matheson joins us now to talk about this. Ros, what's the objective here?
Well, it's really, in a way, part of a pattern about setting the table on either side into this meeting between Xi Jinping and Donald Trump. So you're seeing these series of tit-for-tat actions that are happening in key sectors, of course, including tech, drones, and the solar sector more recently as well. But it's in a way about putting out their stalls on either side ahead of this meeting versus tipping things back into a full-blown trade conflict. So Donald Trump has an incentive to show the American people that he's being tough going into that meeting. Xi Jinping has the similar incentive at home, but equally they don't can't afford to have a resumption of a full-blown trade conflict on either side. So it's really about setting the table for that, taking these actions against each other in that long list of sectors that we've seen in recent weeks, but avoiding things going too far in the wrong direction.
Ros, next week, life's going to get interesting, though, even more interesting. We apparently have the Treasury Secretary, Scott Bessent, announcing his economic isolation plan for Iran. Now, it would be hard to economically isolate Iran without in some way involving China. How's that going to work, and is it further going to raise tension?
Well, it's going to be really interesting to see the details of that economic isolation plan, because so far the efforts to isolate Iran haven't really succeeded. The regime has many, many years of the ability to withstand sanctions and other financial and economic pressure. They've shown they can do that. So it's a bit unclear what's left in the cupboard at this point to pressure Iran. And of course, efforts to get China to lean on Iran haven't been particularly successful either. But as you say, there is that element of the economic relationship between Iran and China. And like other countries, China has been hit by the shortages of energy, given the partial closure, the full closure, the temporary closure of the Strait of Hormuz that we've seen periodically in recent months. And that's impacted China like it's impacted other countries, and obviously reliant on Iran to some extent there. They're like others seeking to diversify as well, but there would be an impact potentially on China, at least at the margins economically, from all of this. Again, the question is, how does China view all of that? Do they see that as something that's irritating, but not something that they really want to see upend the broader relationship with the US when it comes to trade questions? Probably. They're pretty good at compartmentalizing in China, and so they might see it as something like that. But really, the devil's going to be in the details of that plan to see just how much it might impact China economically.
We look forward to the details next week. Ros, thanks for the update. Really appreciate it. And the analysis, Ros Matheson. We're going to get that announcement, we understand, from the Treasury Secretary next week. Talking of the Treasury, let's turn our attention to what happened with this 30-year auction that we saw yesterday, drawing the highest yield in 25 years. Demand was actually OK, but the yield was pushed higher. Let's talk about the implications of this and what it tells us as well. Bloomberg's Scarlett Montgomery-Koenig joining me now. Good morning. Good morning again. Why yields higher? This doesn't feel like it's about inflation. This feels like we're now in a battle for capital.
I mean, is it not just like a bunch of negative stuff coming together in terms of this week? We also had the announcement that the U.S. deficit was the largest on record in July. So, yes, it's the fact that you've got deficits increasing and the U.S. is a net debtor that relies on foreign inflows. And the Dallas Fed that says that for every 1% increase you get in deficit GDP, it's a 16 basis point increase on the long end. You've also got yields being pushed up by the fact that you've got demand for capital rising, and the supply shocks add to all of that, right? Because it means you want greater compensation for that risk, because bonds aren't insulating you from the fact that equities sell off because growth is under pressure, and you have more economic uncertainty. That means inflation's more volatile.
Let's turn to the front end. We're trying to figure out what the Fed's going to do. It feels like we're dialing that down a little bit right now. We've got some data coming out a little bit later on. UMich data is going to be coming out. We've also got retail sales coming out. What is that going to tell us, and how's that going to inform this debate further?
The retail sales print is especially important in the U.S. versus other places because 70% of the U.S. economy is consumption. So whether we get a read on that in a positive way can tell you whether or not you should be worried about how wages are feeding into the economy from an inflationary perspective. What I will say is the data that we've gotten so far in the past couple of months shifts dovish, right? We've had two softer CPI prints. We had PPI yesterday, and that was very much on the dovish side. I think the issue is inflation's been above target in the U.S. for so long now. The Fed needs to kind of have its inflation fighting credibility validated. And yes, it's come down, but you're still above 3%. So you can't get rid of that hike that's very much priced for this year. And the question is just, is it a one and done that's not really necessary? Or do we have the data turn enough that it's not required at all?
Yeah. And there's other factors which could come down the pike towards us in terms of pushing inflation the other direction as well. look at what is happening with the weather and food prices. Scarlett, thank you very much indeed. Scarlett Montgomery-Koenig joining us on what we saw yesterday with that 30-year and what it tells us about where we go next in terms of A, inflation, and B, this competition for capital. Right, let's talk about some of the other top stories that are trending on the terminal this Friday morning. First up, the US will soon announce what it's described as unprecedented economic measures against Iran. We think this is going to happen next week. It is, of course, in an effort to force Tehran's capitulation after almost 6 months of war. Speaking to Newsmax, Treasury Secretary Scott Bessent said the move will be part of a, quote, 1-2 punch that includes the continued blockade of Iran's ports. Up next, Citadel is requiring non-compete agreements of as long as 2 years for investing staff, including some analysts, to prevent employees from defecting to rivals. Citadel's terms are ranking other firms, with one founder calling the lengthy analyst sit-outs predatory and an abuse of leverage over young people. And here in the UK, Reform UK leader Nigel Farage has won a special election in the seat of Clacton in the southeast of England. Now, Farage took more than 22,000 votes, a winning margin of nearly 13,000 over the second-place candidate, Count Binface, who has a bin on his head. The special election was triggered by Farage as he sought to defuse a parliamentary standards investigation, which we understand this morning has been reinstituted. OK. What have we got coming up for you? We're going to be talking more about what's happening with these markets. We'll get back to that in just a second. And we'll talk about the Wall Street week that's coming up later this Friday. This is Bloomberg. Friday the 14th, good morning, 18 minutes past the hour. You're watching Bloomberg Brief. I'm Guy Johnson in London. Let's talk about what is happening with global shipping. The closing of the Strait of Hormuz has reminded the world that geography creates a handful of points around the globe that can wreak havoc when it comes to commerce if they are cut off. Wall Street Week took a look at one massive project Mexico is undertaking to try and create an alternative to one of the world's most famous waterways.
We're standing at the terminal for the train ship here at Coatzacoalcos. This is the only one in Latin America, and it's become a very important service here.
This port in Coatzacoalcos is one end of the so-called dry canal cutting across Mexico, a combination of rail and road connecting the Pacific Ocean to the Gulf of Mexico.
I've seen it described online as a competitor to the Panama Canal. Do you see it that way?
Of course not. No, I mean, the corridor is just an alternative. For some industries or for some companies, the corridor will be a better alternative at some point. And some of the times, you're going to use just the Panama Canal. At the beginning, it was offering service only for all the oil and derivatives industry. But today, with the growth of the rail service here at the south of Mexico, companies located at the very south of Mexico are considering to use also this service to get to Florida or even to New York.
And that need for alternatives is rising as supply chain choke points become a recurring feature in the world today.
We were used in an environment where choke points were considered, I would say, secure of access, reasonably accessible, but now it seems to be more and more uncertain in certain areas. When these strategic location gets disrupted, it creates significant, you could say, domino effect on international trade, either by limiting, you could say, opportunities, accessibility to key resources and markets, or most of the time imposing substantial deviations over long distances, which creates stress on global supply chains.
Okay, let's talk about these choke points a little bit more. Bloomberg Wall Street Week's Simon Hampton joins us around the desk. Is this a genuine alternative? There are choke points everywhere, and they're emerging as a serious risk. Others are now trying to figure out how you get round them. The UAE is trying to do it in the Gulf. Talk to me about this Mexico option and whether or not is it a genuine alternative, and are people beginning to increasingly see it that way?
I think eventually they want it to be a genuine alternative. I don't think it's there yet. I think it is still an emergency option. They saw in 2023 when the Panama Canal was closed, a lot of companies went to the Mexico corridor to see what they could handle. So they got a lot of interest then. They're still working on a lot of interest, on bringing the interest up at the moment. But you have to remember, the Panama Canal moves around 20 million containers every year. The most optimistic forecasts for Mexico's new trade corridor have it moving around 1.5 million containers by 2035. So it's still much smaller than the Panama Canal. And it takes a long time for global trade routes to be significantly restructured. So I think initially it's going to be an emergency option, but I think Mexico sees it 10, 20, 30 years down the line, it can become a genuine alternative.
There's lots of these things beginning to kind of emerge around the world. Fascinating. A great piece. We're looking forward to watching it a little bit later on. Bloomberg's Simon Hampton, thank you very much indeed. You want to watch it? You can do so. Wall Street Week tonight, 6 p.m. in New York. Stay up late in London. 11 p.m. is when you'll be able to watch that. Coming up, President Trump expanding capabilities to combat transnational cyber-enabled crime. More on that and a look at what else is making the front pages. We'll do that next. This is Bloomberg. OK, let's give you some front page news. This is the one I picked. The New York Times leading with the Trump administration enlisting private companies to conduct cyber attacks on foreign criminals. It's a major policy shift that experts say could come with some big legal risk for these companies. Up next, Stephanie Guild from Robinhood is going to be joining us. We'll get back to the markets. That's next. This is Bloomberg. Morning, welcome back. Approaching 5:30 a.m. in New York, 10:30 a.m. here in London. I'm Guy Johnson. I'm in for Vonnie Quinn with your Bloomberg brief. OK, let's get things set up. Let's check in on where we are with these markets. US stocks notching fresh record highs Thursday as the latest read on inflation dampened rate hike bets. Retail sales, UMich out later. Looking forward to that. Even he's fairly flat right now. Crude bouncing back. This as Treasury Secretary Bessent readies what's being described as an unprecedented economic isolation plan for Iran. And Washington targeting Beijing with 100% tariffs on imported drones. OK, let's get back to these markets, check in on where we are. S&P futures, nothing to see here. Nasdaq futures a little firmer. Keep an eye on AMAT today. We'll come back to AMAT a little bit later on. The dollar's down as well. Unsurprising, given the fact that what we're seeing here is basically a dialing down of expectations surrounding the Fed. You got that yesterday on the back of the data, and we're continuing to see it. We'll watch the retail sales number and the UMich data a little bit later on. In terms of what we're getting elsewhere, keep an eye on what is happening in the bond market. Bond market's getting super interesting right now, folks. Look, you've got a 10-year yield at 4.65. Are we going to track towards 5? You've already got 5 on a US 30-year. Now, yesterday's auction was fascinating, well supported, but we haven't seen this kind of yield number since 2001. The competition for capital is starting to get brutal. Are we going to see crowding out? What effect will that have? Crude's up, but beginning to fade a little bit right now. We were up much more earlier on in the European session. We're only up by around 0.5% right now. Let's talk about some of the stocks you want to be watching and paying attention to. AMAT is definitely on deck this morning. The numbers yesterday look good, but this stock has had a great run into these figures. The estimate beating forecast with revenue approximately $10.3 billion in the fiscal fourth quarter. It did it, but the problem is, though, expectations were high. Drone makers are up as well. The reason you're getting a pretty big boost from President Trump talking about tariffs coming through on imported drones, 100% levies on imported drones, plus also components. The idea definitely here that we're seeing the US targeting China. And Reddit shares are jumping. The social media company announcing its stock is set for S&P index inclusion. I think it's, it is, just before we get the opening trade on August the 18th. So that's going to have, obviously, a pretty big sort of effect as we see so much index tracking right now. Look at the stock reacting to that, 12.6% to the upside. So we're just under 3 hours until we get US retail sales. You've got UMich data coming out a little bit later on as well. That's going to be an interesting indicator in terms of how embedded expectations are for inflation. We're getting signs, though, from the data that we are, at least short-term, getting some cooling in the inflation data. You've certainly seen that in the latest numbers. You've also got, it looks like the oil trade beginning to calm down a little bit. We're through the bulk of the earnings season. It went pretty well. Stephanie Guild, CIO of Robinhood, joining us now to discuss all of this. Good morning, Stephanie. Thanks for getting up early. Look, we seem to be in a situation where actually the big risks we were worrying about a few weeks ago, they're behind us now. So is it risk on? Can we re-lever? The momentum trade delevered pretty hard as well. Are we going to see that re-leveraging, and is that going to push equities higher from here?
Yeah, I mean, I think so. I think you summarized it very well. I did a deep dive. I was just thinking about like the situational awareness, hedge fund blow up. This has happened several times in history. It happens when, as you said, leverage builds up and a trade gets pretty crowded. And then when that ends, everyone exits the same door. And that's a clearing event. And I do think we're in that situation. And I think we're a little bit more like, because if you look at the last couple of situations, it was an ominous sign where very soon after that, things started to get worse. But I think in 1998 with long-term capital management, it was kind of more of a clearing event, and the markets were up another 35% from there. And we had another year and a half before things started getting a little bit dodgy after that. But I think this market is also I've been kind of thinking about how intelligence it's kind of quantitative intelligence. The tech firms, the largest tech firms, are funding, and providing capital for an expansion of intelligence. And I do think that speeds up the markets hugely. And so I think you'll have more of this where you have like a building of leverage, a building of the markets, and then a clearing event, and then we move on. And I think all of that will be much faster rather than, let's say, the couple of years after long-term capital management where, it was sort of 2 years of doldrums in the market.
Okay. Those clearing events, do they get bigger? Kind of what amplitude are we talking about here? Obviously, after 2000, we saw a big drop, but it happened over a reasonably kind of elongated period of time. Are you suggesting that when we do get these drawdowns, they're very short and you have to catch them? Say you got a 2000-like drop, how quickly could the market come back off that?
Yeah, I think it comes back much quicker. I mean, there were obviously extenuating circumstances at that time, related to conflict and the terrible things that happened here in New York in 2001. But I think you do have faster jump backs. I think information, it comes back so much faster. I mean, we thought the internet age would bring information to us more quickly. I think in this case, it's 10x that now. And so I do think you have shorter time periods where we have drawdowns, and that either means you stay invested through it and you just bear the volatility, or you just have to really watch when you think things are getting too high. I mean, I remember back in June, I just thought like this is getting a little crazy with all of the ramp up in leverage ETFs and the multi-asset hedge funds taking lots of leverage.
Do you think it's an interesting question as to whether or not how do you deal with that? How big could a drop down be? So post 29, it took years, decades to come back. 2000, it took a couple of years. 2008, the timeline was even shorter. How, is it months? Is it weeks? Is it days? And how brutal could the drop down be if we're assuming that on the other side of it there is this bounce? As you say, people are going to stay invested. So do we not get big drop downs? If I think that the market's going to come back, I don't disinvest, I don't sell, I don't panic. So do you ever get these big drops that we've seen in prior history?
Yeah, I mean, it's a good question. I think you can, because if they're deep enough, I think you scare enough people, and then you do have a pullback. And part of this is because trades can get crowded. And so everyone ends up, like a lot of the quantitative funds, I think, again, with quantitative intelligence, you have a lot of agents. And if they all start seeing the same thing, then you end up getting a lot more the same sales coming through. And so that ends up having like maybe a deep drop down. I don't think that you can't have a bear market, but I do think these kinds of things can recover more like a time period, perhaps in 2022, where we had a bear market, but we started recovering. You know, that was kind of a summer of a bear market, and we started recovering in November. So that was a few months, and that's what I think you end up having. And because it's not just players in the market like long-term holders. You know, we've got lots of different players now in the market.
Near term, though, are we going to... we're into the kind of really quiet period of the summer. Michael Hartnett, B of A's out with a line this morning. He just expects markets to rip higher. What does a rip higher look like for you?
Yeah, I mean, I agree with that. I still think there's a skepticism in the market, and you can kind of see it when you look at like valuations. You know, you've seen earnings growth expectations double for 2026, and I know we look a little further than that, and 2027 hasn't really moved. But you know, you've also seen with the doubling of earnings growth expectations, valuations have actually dropped 2 turns for the S&P anyway. And so I think you still have some people who are a little bit like, oh, this is, you know, and you've seen it in some of the earnings. You can see like AMAT, right? Like that, yeah. That's one of them. And you see like people are skeptical of the returns for CapEx, and that I think it's fair. And I think that skepticism allows the market actually to continue to rip. Okay. The one concern obviously I have is interest rates, and the fact that we have so much supply of that. You do have rising supply of debt because the tech companies are becoming banks. And then, you know, it's not without risk. And so that's something you have to watch. Yeah. But
tech companies becoming banks sounds like
going higher.
Tech companies becoming banks sounds like a definitely risky phenomenon. But what you're speaking to is this idea that we've now got this kind of competition for capital, and it's hotting up. The government obviously has a lot of debt to issue. AI companies have a lot of debt to issue. Tech companies are becoming banks. We talked about what was obviously happening with NVIDIA earlier on this week. What does that competition for capital mean? Where does it show up? Who's going to suffer? Who's going to win?
I do think, I mean, that's why Treasury yields are going higher, I think. And even though we have good growth, right, like generally across the upper end of the economy, and so that's going to support higher rates. I do think that is one of the big risks, that you could end up seeing like the 10-year going beyond 5%. And that could end up, you know, kind of curtailing, keeping interest, or I'd say valuations lower, and having just kind of a short-term reaction to that. And that also has an impact on how fast the build out for AI can happen. I think you end up having also from that, you know, a lot of private credit buildup, which I know was a risk kind of earlier this year that people were talking about, and I don't think that's gone away. But I think that's why you could have these, you know, kind of parabolic moves in the market, yep. And then speed crashes, and then that becomes a clearing event, and things move on. So I definitely think players in the market, especially the everyday investor, has to be more used to higher volatility.
Getting used to higher volatility, that sounds tough. Stephanie, thanks for getting up early on a Friday. Hope the rest of the day goes well. Stephanie Guild of Robinhood, thank you very much indeed. Now to some of the other top stories trending on the terminal this morning. First up, the US has sent a document to NATO members asking questions to gauge support for Donald Trump's policies, including whether countries have been, quote, publicly supportive of US foreign policy. NATO allies have balked at the move, seeing it as an attempt to strong-arm them into ideological alignment in exchange for US protection. As we were just talking about, Bank of America's Michael Hartnett sees a Republican Senate win fueling a stock rally. Success in the midterm elections for the Republicans and the Texas gubernatorial contest would be particularly positive for artificial intelligence stocks, the team writes. The note adds that US stocks and volatility have historically risen in the months leading up to the midterms. And Thrive Capital's 2022 early stage venture capital fund has grown to be worth more than $3.7 billion as of the end of June. Net of fees and other charges, of course. The firm is pursuing a minority investment from its original shareholder group and potentially new parties which would sell a stake of Thrive in exchange for investor exposure to all of its entities. OK, what have we got coming up for you? Oil climbing. We're off our highs, but the US Treasury Secretary making waves. Scott Bessent says the US will step up economic pressure against Iran, and it's going to do so next week. We'll talk about it next. This is Bloomberg.
Watch this space for more announcements coming next week, because we are going to apply measures like have never been seen in the history of economic isolation on a country. So it will be a combination of economic isolation like the world has never seen before, and the continued blockade in the Strait of Hormuz that will keep anything from going in or out of the Iranian ports.
Okay, Treasury Secretary Scott Bessent in an interview with Newsmax there. The US apparently is preparing economic sanctions to try and force Iran to negotiate. This, of course, after almost 6 months of war. Joining us now from Washington, Liliana Byington of Bloomberg Government. Do we know any details? What does this look like?
Right. We don't know many of the details yet. We know that this is coming next week and that it's going to be economic pressure on Iran, but we don't know the details as of now. What we do know is that Iran has already taken a big hit over the course of the conflict to its industrial capacity, to its crude exports. So it's unclear right now what would force Iran's hand when it comes to additional economic pressure. Obviously, they've already faced heavy sanctions over the course of this conflict, like you mentioned, longer than the administration had expected. And so it's unclear right now what would change that, but the Strait obviously has been and continues to be a sticking point for this conflict.
We've also got news on drones. The Trump administration putting 100% tariffs on drones aimed at China. What's the objective here?
Right. China has dominated the drone market for some time. It's something that Congress and the administration has targeted in recent years. And this is just a further escalation of that. By placing these heavy tariffs on these advanced drones, the administration is hoping to boost American manufacturers. Trump has obviously made tariffs a central pillar of his foreign and trade policies. So this is just a continued on that path, and it's further escalating, trying to get up to 100% on imported drones, forcing the hand and kind of forcing the U.S. to not rely on foreign suppliers like China.
Liliana, Jared Kushner is going to be in Israel next week. He's there. We're expecting talks on the Gaza peace plan. Feels like it's stalled right now. Is he going to re-energize it? What are we expecting in terms of progress?
Right. Kushner's been kind of the central person with these Middle East talks this term and the last one. This would be Kushner's first trip to Israel since January. It comes after kind of significant developments with the Israel rejecting the latest proposal, and kind of where we stand now is just this conflict is a lot longer than the administration had hoped, and Kushner's presence there is hoping to kind of change that. Obviously, we don't know yet what's going to come of it, but the White House doesn't want the Israeli elections to stall implementation of the next phase of his plan, and so Kushner's presence there this week is kind of going to determine whether or not that's the case.
Yep. Upcoming elections, obviously a huge factor there. Liliana, thank you very much indeed. Liliana Byington, Bloomberg Government, joining us out of Washington. OK, let's turn to the tech story. Back to the tech story. OpenAI building momentum. An IPO is coming. Bloomberg has learned that the AI giant is on track to generate annualized revenue of over $40 billion. And that doubles last year's performance. Matt Bloxham, senior analyst at Bloomberg Intelligence, joining me once again. Is $40 billion a big number?
It's big, but not as big as some of its rivals. I mean, Anthropic went through $47 billion back in May, I think. So they are playing catch-up. And obviously, this revenue figure is incredibly important for an IPO because there's no profit in these companies. Yeah. And so enterprise value to sales is the multiple on which these values will get struck. That's how deals will get struck. That's how SpaceX happened. It's how Anthropic will go. That's how OpenAI will go. So the bigger the number in the near term and the convincing story behind how that number is going to continue to grow at a rapid rate is hugely important for the multiple they will get.
Let's talk about chips, chip designs, lithography, AMAT. Out with those were good numbers.
Yeah.
But the run-up, I'm assuming, has been good as well.
It has. Yeah, obviously the shares have come off a little bit in the last month or so. We kind of saw something similar with Cisco, that they kind of thought they were kind of giving a good positive guide on the contribution of AI to their overall revenue for a revenue number for the next 12 months, which was much, much better than the market expected, and yet disappointment. So I think it is this kind of trade-off between expectations and what's delivered. And as much as the number was a beat, it wasn't a big enough beat to kind of really move people higher. They're kind of always thinking in the back of your head, we penciled in an optimistic number, but really we think they're going to kind of do even better than we've got in our heads, and they didn't quite do that. So in black and white, the business is doing well. Clearly the fundamentals underpinning the business are strong, but it's just that relative expectations.
Is it, to what extent also is there fear now that the Chinese can do some of this stuff, beginning to be able to do some of this stuff? Is that part of the kind of the background narrative there?
I think in some parts of the AI value chain, yes. I think perhaps at the kind of level that the likes of AMAT and SML are, I think, no, there's a bigger kind of development gap, much more at the model and perhaps even at the kind of actual chip end, there's a narrower gap, but they're still heavily reliant on European and US technology for the actual kind of fab stuff.
It seems to me the market's getting a little bit more selective now in tech. Is that your impression as well? Not everything is kind of clicking in the way that it once did. Everything, all boats went up previously. It now feels slightly different to that.
I think that's true, but I think we're going through a number of cycles of that kind of more kind of discerning judgment, if you like. And, I think trades suddenly get crowded very quickly, and then people are looking for the next opportunity. And the AI story is still unfolding. We've still got lots of twists and turns that no one's even really thinking about yet, and that will suddenly create new opportunities. I mean, let's face it, 6 months ago, nobody was probably really thinking that the kind of traditional server market that's helped the likes of Intel in particular would suddenly kind of flourish into life the way it has. And so now you've seen that trade go there. There are going to be other things that come along that people have kind of overlooked or kind of undervalued, which will come into focus.
And that's why we come and talk to you. Matt, thanks very much indeed. Matt Blogson of Bloomberg Intelligence on the tech trade. Coming up, more data on deck. It's a busy day, actually. Retail sales is going to be interesting. Umich is going to be interesting. We'll talk about it next. This is Bloomberg. Friday the 14th, good morning. This is the Bloomberg Brief. I'm Guy Johnson in London. E-minis pretty flat right now. What else do you need today? Let's take a look at the day ahead. US retail sales, 8:30 a.m. Eastern. UMich data, University of Michigan consumer sentiment data, 10 a.m. Looking forward to that. Plus, we get a snapshot into some of the closely watched hedge funds. It is 13F filings. Looking forward to seeing what we get Monday on the back of that. Some of the movers you're going to be watching on the market this morning, AMAT is definitely one of them. Applied Materials looks like it's going to open soft this morning despite beating the street. You're going to get a whole bunch of drone-related stocks. Unusual Machines is one of them. It's going to be up on the fact that we're getting 100% tariffs applied to imported Chinese goods. And Reddit looks like it's going to be up. It's going to be entering the S&P on Tuesday morning. Looking forward to that. Macro movers, Brent's up a little bit. The US 30-year remains in focus. Have a great weekend, folks. That's it for Bloomberg Brief. Surveillance is next.